Hi everyone. In this short video, I just want to show you how to construct a T account. Um, in our last session, we walked through an example, which is to use the direct method to prepare the cash flow statement. And one step is to construct a T account to work out the cash flow impact. So some people are not very familiar with the T account in terms of how to construct that. So just a quick example to show you how to do that. So the question is, on the balance sheet, we can find that there's a item called equipment at cost. The opening balance is 2 million. The closing balance is 2.5 million. Okay, and we are also told that equipment was purchased by cash during the year. Okay, so that's all about equipment at cost. And there's no mention of the sales of the equipment. So from this information, we know very well, say, when an equipment was purchased, what we will need to do is we will debit equipment and we will credit cash. Okay, so now let's construct the T account. So first, the T account we are constructing is equipment at cost. This is an asset account. So asset account, the opening balance is always on the debit side, okay? And the closing balance is on the credit side. So when you construct an T account, what you need to do is you put title, say equipment at cost, you write debit on the left, credit on the right, then you think about, is this an asset account or liability account? If it's an asset account, I put opening balance here, I put closing balance on the credit side, okay? Then we just need to fill in the numbers. Opening balance is 2 million, closing balance is 2.5 million, and that's it. So the total closing balance total on the credit side is 2.5 million. So on the debit side, we also need to derive at a number of 2.5 million. So what is the missing figure? That is 0.5 million. And that is the purchase of equipment, 0.5 million. Okay, and this is a cash outflow. So you can see, actually, if we don't need to draw this cash T account, but just to give you an idea, you can see when we debit equipment at cost 0.5, we credit cash 0.5 million and cash decrease. That's why here is cash outflow 0.5 million. Okay, so in the real exam, you don't need to go right that into that detail. So sometimes we just short say cash, which actually means is the cash outflow because of the purchase of equipment. So T account still comes back to the journal. When you draw the T account, you probably just need to think what is the journal for that particular activity. And some of the activity were provided in dot points in the question. So you would need to think what will be the journal that was involved in this transaction and whether it has a cash flow impact. Okay, so that's how we draw this T account. And I hope this is helpful.